This video, created by the University of Missouri Agricultural Business and Policy Extension Program, provides information on how to determine cash rental rates from the perspective of a property owner. A property owner has several objectives when leasing their property. They want income for a living. They may want to preserve the land for others and to benefit their community. To meet their objectives, they typically need to cover all the expenses associated with owning property. They also want to receive a desired return on their investment. Landowners can receive two types of return from leased land: annual cash rental rate and capital gains. The lease rate less expenses plus the capital gains is the total return to the land. Understanding annual returns and capital gains can help a property owner estimate the lease rate she would like to be paid. Capital gain is measured by how much the land appreciates over time. Average land values in Missouri have increased from $1,200 per acre in 2000 to $4,200 per acre in 2022. Land values increased in most years, but decreased in some years. Over time, Missouri land values have appreciated 5.7% per year. Rental payments are the annual return to property ownership. According to the USDA, Missouri annual rent-to-land value decreased between 2009 and 2022 from 4.5% to 3.5%. However, the 3.5% of land value rental payment that landowners receive is not all a return to ownership. They must pay ownership expenses from the rental payment. The rental rate is not a fixed percentage of land value. It is a decision of the landowner. While 3.5% was the average in 2022, an individual landowner may charge more or less than that amount, depending on her objectives for land ownership. The rental rate charged to a tenant needs to cover all the costs of owning the rented property. So, it's appropriate to first list ownership costs when determining cash rental rates. Property owners almost always pay taxes and insurance on their property. They may also have expenses associated with land improvements, such as tiling or terracing. To these costs of owning property, the landowner needs to add their desired annual return on investment in the property. This desired annual return is in addition to any expected capital gains on the property. The landowner's desired annual return is calculated by listing the value of the land, the desired return on the land, and the expenses associated with the land. The sum of the desired annual return and the costs of ownership is the starting point for negotiating a rental rate on the property. In this example, the property owner would like to receive a 3% annual return on her investment in land and pay the ownership costs of property tax, insurance, and terracing. This totals $190 per acre in this example. Listing the costs of owning property does not determine the rent. It outlines the landowner's contribution to the farming activity and helps her understand her financial objectives. She can use this summary to explain her needs and objectives to the tenant when negotiating the rental rate. At this time, it might be useful for the property owner to compare her desired rental rate with rental rates published by the USDA or their extension service. This comparison helps the property owner determine if her desired rental rate is realistic. The landowner should also review all her objectives of owning property. These may impact negotiations with possible tenants. Some landowners charge lower rates to help beginning farmers or family members. Some insist on certain production activities that increase the contribution of the tenant and perhaps lower what they receive in rent. The tenant may bargain for a lower rental rate. Reconciling the difference between what the landowner wants and what the tenant is willing to pay requires negotiation. During negotiation, the property owner may lower her desired return on investment or opt to receive compensation other than rent payments. She may require the tenant to repair fences, maintain grassed waterways, or plant cover crops. These non-cash tenant contributions may lower the actual cash rent received, while still meeting the desired rate of return on the land. Landowners are better prepared to discuss rental rates with the tenant when they know their objectives, their costs, and their desired rates of return around which they can negotiate.